Hello, everybody. Thank you so much for joining me today. We do this on a weekly basis, and I know some of you come on a regular basis. Appreciate it. Those of you who just joined us, hopefully you'll find this useful. I usually spend about 15, well, I'm supposed to spend 15 to 20 minutes in a monologue going over some of the issues that are relevant to the markets and looking at some of the charts that we put together in the morning briefing for Monday. And we'll do that for sure. And then I try to leave some room for Q&A, but sometimes, unfortunately, I can be long-winded. So I'll try to control that impulse of mine. There's a chill in the air here in Long Island. It feels like fall, which is what it's supposed to feel like. And we're enjoying it. It's actually been pretty sunny, though every weekend we've been getting rain. It's during the week that as I'm writing that I'm looking out at my glass door here and seeing a beautiful day out there. But speaking of chills, there's been a lot of chills geopolitically in terms of what has been going on for quite some time. And the Ukraine looks like the Ukraine offensive against Russia hasn't gone all that well. And so this is a war that looks like it's going to be with us for a while. And then all of a sudden, out of the blue, let me just turn that off. Do that again. Then out of the blue, we had the situation, a horrible situation in the Middle East. So there's certainly a chill in the air when it comes to the chilling atrocities really going on in Ukraine and in the Middle East. So it's an ugly situation, and maybe it's one of the reasons that on Friday when Jamie Dimon discussed the J.P. Morgan's results, he sounded pretty pessimistic at first. He said that this is the most dangerous times that we've faced in decades. He's been a pessimist for a while, as you know. I mean, it's not as though there aren't legitimate reasons for being pessimistic. However, he did start out last May talking about a potential recession, a hurricane, a consumer-led downturn, and it was supposed to happen really just about now. Back then, he said that things looked pretty good to him, but he thought that the consumers were going to run out of excess savings and that they would have to retrench, and we should be seeing that now. And that hasn't happened yet. I guess we'll see tomorrow how retail sales play out. Maybe that'll give us some indication of whether the consumers are retrenching or not. But keep in mind, retail sales have been flat in real terms really for the past 2 years, so they haven't gone anywhere. They've been flat at a record high, which is still pretty impressive that they've been able to maintain that kind of pace since the pandemic. But the reason they've been flat is because consumers have switched over to services. So we'll be watching those numbers closely. Auto sales have basically been going nowhere. But I guess one of the reasons that Jamie Dimon is depressed is not only is he depressed about the geopolitical situation, but and the dangers of all that, but he's also been talking about interest rates going up to 7%. It's not quite clear to me whether he meant the Fed funds rate or the bond yield. I think he meant both. That we're going to see 7% kind of across the curve, which implies, I think, that he's fairly pessimistic about the outlook for inflation. And he's mentioned that the geopolitical problems could come back to once again push up food and energy prices. That could lead to higher wages, and so we get a wage price spiral, and throw in rents as we get a wage price rent spiral. So again, these are legitimate concerns. There are lots of people out there who still think a recession's coming. I did notice that according to the Wall Street Journal, fewer economists are now looking for a recession. We're not in the recession camp. We think the economy continues to grow through 2024. Then ask me again. But on the other hand, a couple of weeks ago, actually in response to what happened in the Middle East, I raised the recession odds from 25% to 30%. And back, I guess it was in the summer, we had raised it from 15 to 25%. So we basically, in less than half a year, have raised our recession risks from 15% to 30%. Some of it is a little bit of the contrary instincts that I have, because as it became clear that we were not going to have a recession imminently, a lot of people started to back off on that forecast. So Debbie and I and the team have been doing more work on what could possibly go wrong. And it's not that hard to figure out. And Jamie Dimon certainly has made some good points, but he's accentuating the negatives, as I wrote in my quick takes. And there are positives. Real GDP is doing very well, which suggests that the economy is remarkably resilient in the face of this backup in short-term rates and long-term rates. And it really looks as though we're kind of back to an old normal where we had 4.5% to 5% 10-year bond yields before the great financial crisis, before the central bank started obsessing about getting the inflation rate up to 2%, before they started to obsessing about quantitative easing and ZIRP, NIRP, remember all those terms, zero interest rates, near zero interest rates, and then NIRP, negative interest rates. So we had all that for quite some time, and all that is for now clearly behind us. But the economy is doing well, and because the economy is doing well, S&P 500 revenues are at all-time record high. Of course, they've been boosted not just by the growth of real GDP, but of course, inflation has been an issue for the economy. But for revenues, it's a booster. I mean, that's why stocks tend to be inflation hedges, broadly speaking, because the revenues of companies go up along with inflation. However, as we know, when inflation is a real problem, that can be the issue of the profit margin. And just because revenues are going up doesn't mean that costs aren't going up. It means that the costs are going up. And if they're going up faster than revenues, obviously you get squeezed in the profit margin. So we have had an earnings recession. It's been pretty mild. It was basically the second half of last year, first half of this year. I think we bottomed in the second quarter. Looks to me as though third quarter S&P 500 earnings per share could very well come in at a record high. Joe and I have been looking at the data, and it's not that hard to accomplish because we didn't really have much of a earnings recession. The revenues kept going up to record highs. It's the profit margin that caused the earnings recession. It got squeezed as costs rose faster than prices there last year and early this year. But in recent weeks, we started to see that analyst expectations for forward profit margins on a weekly basis have actually started to turn up, and it looks as though the profit margin for the S&P 500 might very well have bottomed in the first quarter and showing some signs of stabilizing in the second quarter. And let's see what happens in the third quarter. We think the profit margin is going to be up. And by the way, it didn't go down much at all. So while we've had a profit margin-led earnings recession, the reason is it was mild because the profit margin really didn't get whacked as much as one would have thought in an environment where costs are going up. So we've got GDP, we got earnings on the positive side. Then, of course, it's still controversial. It's still debatable. On inflation, we think that inflation's moderating, and I'll go through some of the charts for the morning briefing in a minute to make my case for that. But I think it's important to recognize that when we're talking about inflation, we're not talking about individual components. I know people are getting bent out of shape about health insurance, which was actually a deflationary contributor to the CPI over the past several months. Now is going to reverse and start to be an inflationary contributor. I think we have to look at the overall CPI. Well, you know my take on these numbers. The numbers are good as long as they support my story. If they don't support my story, then let's take some numbers out until we find the ones that make that support the story. But so we all do that, obviously, with core inflation. We take out food and energy because they do tend to be volatile and they do tend to be hard to predict, but they do matter. I mean, if food and energy prices are going up a lot, that could have an impact. That will have an impact on wages, and then you get the wage price spiral. So I don't think we can just completely ignore them. So when we take out the core food and energy, we at least have to have some story there about which way they're likely to head, and maybe offset or confirm the kind of inflation forecast we or you might have. Um, we've taken out shelter in the charts I'll show you in a minute, because shelter has been a major laggard in the disinflation that we've seen since last year, and we'll get into that in a minute. But we think inflation is already down substantially, and it's continuing to moderate, and will moderate some more as shelter inflation moderates. So we put that on the accentuating the positive side. Then I think the Fed is done. The Fed's excuse is that the bond yield has gone up significantly. It's gone up from about 4% to 4.7%, 4.8% since the summer, and that's equivalent to 2 rate hikes right there. So I think the Fed can certainly make the case, and some Fed officials have made the case, that there's really no reason for further rate hikes, that all they have to do is leave it here. That's restrictive enough, and that'll bring inflation down, which then gets us to another debatable point, and that is, what is the 10-year yield stabilizing? I'm not saying it's coming down. I think all the stock market wants is for the bond yield to stabilize. And I think it is stabilizing between 4.5% and 5%. Jamie Dimon's talking 7%. There's other people out there talking about going up to at least 5% and maybe even higher than that. So I think there's some actual positive developments, and I think there's some potential positive developments, at least in the scenario that we have. Recognizing, of course, that things could go wrong for our happy forecast and make us and everybody else really quite unhappy. Well, I think one of the key to whether we're going to be happy or not in the next several months will continue to be inflation. So let's go and take a look at some of the inflation charts here. All right. So we've got the just looking at some incoming notes here. So we've got some new charts where you're my focus group here. Let me know how you like them, and even if you don't like them, sorry, but we're probably going to segue into this kind of look. We're basically partnering with LSEG, London Stock Exchange Group, and DataStream to do these charts. There's a lot of advantages to this platform over the one we've been using. The internal one's been sort of a homegrown program that automatically updates charts. Now we've got sort of an off-the-shelf program that has a lot of programmers supporting it. So it makes a lot of sense for all sorts of reasons. But here you can see that we're looking at the core CPI and core PCED. At Jackson Hole, if you'll recall, at Jackson Hole, Fed Chair Jerome Powell focused his entire speech on the inflation outlook. And he basically said, look, the Fed focuses on core inflation. Food and energy are hard to predict. So the speech was about core inflation. So here's the core CPI, excluding energy and food, and the same thing for the core PCED. And as you can see, they're still high. They're not even close to the 2% target. They're twice as much. You got the core CPI at 4.1%, the core PCD at 3.9%. This is through September. This is through August. Now, if we look at the CPI, similar kind of analysis, but this time instead of a CPI versus PCED, let's look at the headline CPI versus the core CPI. And the headline's a little bit better, but still, 3.7%. Fed's shooting for 2%, so that's high. Core certainly is high. This is a little history back to 2015 for those of you who are history buffs and want to have a look at where we've been before. But I don't think this is going to turn out to be anything like the 1970s Twin Peaks situation. I think it's a fairly typical kind of spiky, symmetrical spike in inflation. And I think it's going to turn out that it was actually quite transitory as opposed to sticky, which means that it's not going to come down any further than it has, or persistent, which includes the possibility that it would be something like that. I don't, I recognize it could happen, but I don't think it's going to happen. Here's the thing. If we take out, and again, I'm a big fan of taking out what doesn't support the story, so that here is shelter that doesn't support the story, and we all know that there's a legitimate reason for taking out shelter. It's a laggard. It includes all leases that are currently open for the past 2 to 3 years, 1 to 3 years. It doesn't reflect the current lease rates, and we know based on Zillow and apartment lists that rent inflation has come down substantially. So here is what the CPI less shelter and the CPI core less shelter look like. That on 2.0%, 2.0%. Drum roll. I mean, we're there. We're at the Fed's target. But, obviously that's a debatable point because people are saying, well, yeah, but, there were some things that are going to reverse here, like health insurance, and the UAW strike may lead to an increase in auto and new and used car prices, and so on and so forth. A few weeks ago, they were saying, here we go, we're going to go up to $100, maybe $120 a barrel on oil, and so gasoline prices are going to go up, and that'll reverberate and have all kinds of impacts on pushing up other prices. But as we've seen, even with a horrible situation in the Middle East, and with the Iranians threatening that they're going to get into it if Israel attacks Gaza, even despite all that, the price of of petroleum and gasoline have not spiked up. They've actually come down somewhat from a few weeks ago. So here's this is the heart of our story: is that this is a clear confirmation of a transitory inflation problem, and all we got to do is just wait patiently, and we should see the rent inflation. Rent of shelter is basically owner's equivalent rent and rent of primary residence. This is one of the most cockamamie statistics I've ever seen. This is what you would have to pay yourself to rent your own house as your own landlord. But there are statistical reasons that they need to put that in there to balance their accounts. But it makes no sense. So we have the rent of primary residence, which is something that does make sense all the way back to 1960. And you can see we had a big rent inflation spike here. So it was a wage price rent spiral back in the 1970s. And we have that rent problem again here. But again, I think a lot of it was pandemic related. I think it's the aftershocks are dissipating. And I think we're going to see this coming down rather substantially. And that, because it is such a large component of both the headline and the core CPI, that should show some, that should be an important reason for why inflation moderates. And maybe even will offset some pesky things like health insurance going up and so on. Now let's look at, my mouse isn't working as well as the touchscreen here. This is a consumer price index for goods. And I think, we don't have to spend much time on that. It's pretty clear that turned out to be a spike, and it's been very transitory. And a lot of that was durables, and looks like that's over. And now we're actually seeing for durable goods minus 2.2% on a CPI basis. So that's kind of what this was used to doing. There has been a deflationary trend in consumer durables. This is headline and core goods. This is just goods again, so it's the same story. Let's skip that one. This is services. Okay, so services excluding energy and housing. This is the so-called super core. This is what Jerome Powell invented about half a year ago, and said that, well, we're doing okay on goods. Housing's got some issues, so we're not going to pay that much attention to it. But look at these services excluding housing. And so he focused on the PCED, and you can see that it's been kind of flat here around 4.5%, 5%. And that's disturbing. The data's through August. But there's something, I think, an index that's pretty close to that in the CPI, which has come down a lot. This is the CPI services, less housing. Give me 1 second. One of the dogs wants to come in and listen to the call. So just 1 second. And Haley decided to come in, and I guess she'll be snoozing here in a minute too. Sorry about the interruption, but she was scratching on the door. So here we've got the services. So I don't know. I mean, this is not a happy story right here. You can't put lipstick on that pig, as they say. But you can, I think, based on what I'm seeing in services, less housing. And again, the Fed's job isn't to micromanage each component of the CPI and get each one down to 2%. It's to get the overall inflation rate core on a PCED basis down to 2%. And I think the CPI data that we had through September suggests we're certainly still heading in the right direction. Here's that much discussed and feared health insurance component of the CPI. It's measured, I think, based on the profitability of the health insurance companies, which that just makes no sense whatsoever. Making more sense is the PCED measure. I'm not quite sure exactly how these things are measured differently. It's on my to-do list to study them, but probably by the time I do it, nobody will care about it anymore. But I think for October, November, December, there's a good chance this thing shoots up again. But it's a very tiny, it's got a very tiny weight, like 0.554% of the CPI. But if it's a huge increase, it could obviously give us a contribution to a hotter CPI. So but everybody's going to look at it and take it out and say, okay, what's going on? Here's vehicle prices. This is new vehicles, so we'll be watching what's going on with car prices to see whether the UAW strike is having some impact there. My hunch is it's not going to be that big a deal, but I don't know how long the strike's going to last. This is another hopeful sign for the inflation rate for both the core CPI and the core PCED, and that is the core PPI has a component in it, has several components that track final demand of personal consumption. And you can see that that's down to 2.7%, and that does not include rent. So I think that's another good sign that we're still on a moderating trend, that we're not getting stuck or sticky or whatever you want to call it. By the way, some of these sticky indicators that the regional Fed banks have, they got rent in them, so no wonder they're sticky. We're looking at wages here, and you can see that wage inflation has come down quite dramatically. Average hourly earnings, that's the data that comes out with payroll employment. On the other hand, the wage growth tracker is still at 5.2%. Powell said he'd like to see the wage numbers down to 3%. So we're still heading in the right direction. And by the way, so what about this 5.2%? Well, look at it in the context of some history here with average hourly earnings. And you can see that it does tend to, I don't know if the term is overstate, but it tends to be higher than average hourly earnings. So maybe the truth is somewhere in between the two. The average hourly earnings doesn't adjust for industry shifts. So, for example, when a lot of low wage workers lost their jobs during the pandemic, and the high wage workers kept working from home or went to the office or whatever, it made it look like we had a big spurt in wage inflation. So it is a funkier kind of number when things are moving pretty volatile in the labor market. But if things are calming down, as I think they are, quits rates coming down, for example, then this is probably a fairly realistic measure of what wage inflation is doing. One of the reasons wage inflation is continuing to moderate, I think, is the Atlanta Fed has this wage tracker for job stayers versus job switchers, and as you can see, there's the wage increase that you can get for switching has come down quite a bit. So maybe people are settling down to where they are. Expected inflation ticked up a little bit, and I think that was in September. That was certainly gasoline. Now it looks like it's going to tick down. Import prices is a source of deflation. U.S. import price index, as you can see here, down 1.7%, excluding petroleum, down 1.2% year over year. And a big contributor to deflation in some of these import prices is China's inflation situation. You can see that the PPI is minus 2.5%. The CPI there is 0. And that's it. So why don't we open it up for some discussion here? Let me go look. I've got a couple of questions here. Okay, Michael, Jim Paulson notes that last week the market handled surprise inflation news well, but then sold off on negative House Speaker news. Does this indicate the 10-year yield is now mostly about bond vigilantes and therefore higher for longer for the 10-year? Yeah, look, it's hard to see how the 10-year comes magically down to 3.5 to 4.5% in an environment where there's no fiscal discipline. So I think the bond vigilantes are back. The bond vigilantes are focused not on inflationary Fed policy. The Fed seems to have its credibility back intact now that it's, I think, caught up with the inflation curve. It was behind the inflation curve. Now it's probably somewhat ahead of the inflation curve. I think the issue is fiscal profligacy excesses and the lack of political will or interest to do anything about the deficit, because the Washington is so partisan. In a happy scenario, the bond vigilantes keep the bond yield at 4.5 to 5%. Why is that possibly happy? Compared to what? Compared to 5, 6, 7, 8%. That's a very happy scenario, and that's kind of consistent where the 10-year was before the great financial crisis. The economy could live with it then. It certainly seems to be living with it right now, and the stock market doesn't seem to have that much of a problem. Even the valuation multiple, while it's come down, it's still relatively high, even though everybody knows that interest rates have gone up a lot. But some of that valuation stickiness on the upside is clearly attributable to the fact that 27% of the S&P 500 is dominated by the mega cap 8 stocks, and these are highly valued and prized, and they're probably going to be here for a long time and account for at least a quarter, if not more, of the S&P 500, and they're going to be, sticking out with relatively high valuation multiples. Okay, so Chip says he likes the charts better. Okay, that's good. Nice, thank you. Ralph, one of the benefits you bring to our firm is that I tend to focus on the things that can go wrong. Okay, can you provide some insight on the trillions of corporate debt that is coming due over the next 5 years and the impact it will have on earnings and corporate solvency? Oh, okay, Ralph. So I guess what you're saying is you have a tendency to focus on what could go wrong, and you like that I try to balance that off by discussing what could go right. And I do have that bias of being an optimist, but especially times like this when things have worked for the optimists, I do more work on what could go wrong. And you bring up a good point. There's a lot of corporate debt that will be coming due in coming years. They got a big windfall, obviously, refinanced a lot of their debts back in 2020 through 2021. I think it was something like $1.5 trillion of that debt was refinanced. I mean, it's simply accounting. When this stuff, when they've got to refinance their debts, they're going to have to refinance it at much higher interest rates. That could squeeze their margins. They know this. They can plan for it. Well, what can they actually do? I mean, there's nothing you can do about planning for refinancing at higher rates. They are what they are. But you can certainly work on your profit margin. You can certainly increase your productivity. I think ever since 2008, corporations have been laser focused on holding on to their profit margin and increasing it if they possibly can. That might explain why the profit margin really didn't get squeezed that hard in this latest earnings recession that we've had, a minor earnings recession. So there's a lot of moving parts when it comes to profits, and higher interest costs, higher labor costs are the negatives, and that's what that's what pessimists tend to accentuate, which is fine, valid concerns. And all I'm bringing to the table is that there's other factors that may very well mitigate that. And I've been a big a proponent of the view that productivity was starting to make a big comeback. The growth boom for productivity was started in around 2015, late 2015, and continued right before the pandemic. That now that we're past the pandemic, I think we pick up where we left off, and productivity makes a comeback. Cagdis. Despite the recent conflict, S&P has been marching higher over the past 10 days. Where do you see the risks here probabilistically? March higher continues, or we see a downturn again, as Joe seems to fear? Yeah, Joe Feshbach, I asked as a good friend, I asked him for his opinion from a trading perspective. He's been really good over the years, and he's been really good for over a year in his contributions on the market call piece that we put on the weekend. And yes, now he's thinking that something around south of 4,400 is about as good as we're going to get for now. And I don't think that he's put any downsides on the market. He just feels like caution is advisable here. I gave you some of the reasons from a fundamental perspective that I'm somewhat cheerier. But look, given what I do, I tend to forecast beyond Joe's time frame. Joe's very short term, very week to week, even day to day, and that's fine. And he's done a great job. And I like to use Joe's opinions as sort of input to say, okay, if Joe's right, what does that imply might happen on a fundamental basis? And it's been kind of a eerie thing it's been kind of a real mind game because it's been eerie to the extent to which some of his premonitions of where things are going turn out to be correct. Like, the bond yield going up a lot more than I expected or others expected, and so on. So I do follow his work closely, and that's why I brought it to the table. But in terms of the rest of the year, I'm thinking that 200-day moving average, which was basically tested about a week or so ago, I think it's gonna hold. We could maybe retest it one more time, depending on how things go in the Middle East. I think that's still an issue. But the earnings story is good. As I said, I think the Fed's done, so should get more evidence of that. I think the bond market, every day that it's still between 4.5% to 5% is a good day. So I'm of the opinion that we can still have a year-end rally, and I don't know if we'll get back to 4,600, but I think we could, especially if the earnings season turns out to be much better than expected, which is kind of what I expect. Well, that's it. Thank you all very much for tuning in. Have a good week, and let's do this again next week.